Most traders begin their day by drowning themselves in data. They check the daily chart, the 4-hour, the 1-hour, and the 15-minute, often finding conflicting signals across every time frame. By the time they are ready to place a trade, they are paralyzed by the sheer volume of information. This strategy simplifies that process. By analyzing how a single, specific 4-hour candle interacts with the market, you can establish a clear directional bias and identify a precise entry point without the need for additional indicators. Open up your preferred charting software now so we can walk through the build of this setup step by step. Before looking at the price action, there is one non-negotiable requirement. Go to the bottom of your chart, click the time zone settings, and set your clock to Eastern Standard Time. Establishing this specific time-based anchor turns your analysis into a consistent routine. It removes the guesswork of which sessions to prioritize and ensures you are looking at the exact same data points every single day. Start by opening a major currency pair, such as EUR/USD, on the 4-hour time frame. We're isolating one specific period, the information candle. It opens at 1 a.m. Eastern and closes at 5 a.m. You cannot take action while it's forming. Because price fluctuates aggressively, you must wait until it actually closes for the completed information. If you're trading gold or futures, shift this timeline forward by 1 hour. For those assets, use the 2 a.m. to 6 a.m. Eastern candle. Once the candle closes, look at how the price interacted with key structural levels, such as a previous swing high or a fair value gap. We are looking for a rejection, price wicking into a level during the 4-hour window, but reversing to close away from it. This indicates that the market found liquidity and is now likely to expand in the opposite direction. This interaction provides a high probability bias for the next several hours. By focusing on this specific 4-hour reaction, you gain the context you need to look for an entry without overanalyzing the higher timeframes. After the candle closes and your bias is set, immediately move down to the 15-minute timeframe. The 4-hour chart has already done its job of providing direction. Now the 15-minute chart takes over to provide the timing for your execution. Your execution window is strictly defined. You are only permitted to hunt for trade entries between 5 a.m. and 9 a.m. Eastern. If no setup appears in this window, you stay out of the market. Within this window, we wait for a change in state of delivery. This signal shows the lower timeframe's momentum matches our higher timeframe bias. For a bullish setup, 15-minute candles must stop making lower lows, with a definitive close above a recent downclose candle. For a bearish bias, we wait for the opposite, price action that stops making higher highs and closes below a recent up-close candle. This structural shift serves as a final filter for your capital. It ensures immediate price action is moving in your intended direction before committing to the trade. Once the 15-minute candle closes and confirms the shift, you are ready to set your orders. Place your order at the order block created by the shift. Your stop loss goes just beyond the lowest wick of the reversal pattern. If price reaches here, the setup is invalidated. Finally, set your take profit to exactly twice your initial risk. Using the same ratio on every trade makes your exits objective and repeatable. By letting the math handle the outcome of each trade, you remove the emotional pressure of deciding where to take your profits. In a winning scenario, the market expands in your favor, striking your target and concluding the trade within your session. However, no system wins every time. This framework is built on the fact that by capturing twice what you risk on winners, you can remain profitable even if you experience a series of losing trades. You have now replaced hours of chart scrolling with a single context candle, a specific 4-hour window, and one clear execution trigger. Open your charts today and locate yesterday's 1 a.m. Eastern candle. Walk through this 5-step sequence and see how the price responded to the close of that candle. Trading consistency comes from removing the noise. When you have a fixed set of rules, you no longer have to hunt for trades. You simply wait for the market to meet your criteria.